what does that downgrade do? Well, that downgrade, it's a black eye. It's not really good for your reputation, and it's embarrassing, and it's got, you know, all of the all of the chattering class, the political class in Washington, they're running their mouths off today saying, you know, it's not a big deal or anything. Well, it is a big deal because the interest cost on the debt will go up. And that cost, the taxpayers have to pay for that.
Stock markets are sliding on Wednesday with the S&P down about 1.2% and the Nasdaq down 2% on news that Fitch has downgraded the U.S. long-term foreign currency default rating from AA plus to AAA. Why did they do this? What are the ramifications of this on not just the markets but also perception of U.S. strength? We're speaking about this topic with renowned economist Steve Hanke, professor of applied economics at Johns Hopkins University, who has previously served on a number of important engagements, including on Ronald Reagan's Council of Economic Advisors. Welcome back to the show, Professor Hanke.
Great to be with you, David.
Great to be with you as always. Professor, you are probably the best person that I can think of to explain this issue to us. Fitch downgraded the U.S. So this is their reasoning. I'll just read you a paragraph from Fitch. The rating downgrade of the United States reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA and AAA rated peers over the last 2 decades that has manifested in repeated debt limit standoffs and last-minute resolutions. I'll let you respond to this, and then we can drill down into specifics that they mentioned.
Okay, the Fitch downgrade is something I think it caught many people by surprise, kind of looking at it or anticipating it. Most people did not anticipate it, but in looking at it, I'm not surprised after the fact. And what you end up with, if you go to the Congressional Budget Office, these are the technocrats. It's a bipartisan, technocratic part of the U.S. Congress. Congressional Budget Office is, and they do the sharp pencil work on the budget. And what you see by looking at their latest report is that the debt trajectory in the United States it's just not sustainable. Right now, the United States debt to GDP ratio is 98%. It's projected to go up to 115% in 10 years by 2033. And if we go out 30 years to 2053, they have it going up to 181% of GDP. So those are big numbers, but to get your head around the thing, I think the easiest way is to look at the interest expense on that debt as a percent of the budget. And right now it's 10.3% and going up. By 2033, it'll be 14.8%, almost 15%. And in 30 years, if things keep going the way they're going, interest expenditures would be 23% of the total budget. Now that's expenditures for nothing. I mean, they're just interest charges. So this irresponsible government spending has created these deficits, and the deficits, of course, pile up, more and more debt, and that has to be financed with more and more interest charges being made against the taxpayer. So that this idea that you don't ever really have to pay your debt, that, you know, it's ridiculous. You have to pay interest on the debt. Even if you don't amortize the debt, don't pay it down, you have to pay the interest on it. And as interest rates are going up, of course, that, along with the fact that the absolute size of the debt is going up, means that the interest charges are going to be, you know, higher and higher. So in 30 years, what if 25% of the total budget is taken up by paying interest, getting nothing? So that's why the Fitch thing, thinking about it, and it's not surprising. It's not a fatal knockout blow. It's kind of like getting a black eye. Somebody punch you and give you a black eye. It doesn't knock you out or even knock you to the ground, but it's kind of embarrassing.
The idea that the U.S. could even get a black eye, to me, is surprising. As a student of finance, we've learned in school that, well, we were taught at least, that it's inconceivable for the U.S. to default on debt. So the concept of even a downgrade of credit, to me, please correct me if I'm wrong, seems kind of a moot point, because why downgrade something that can't default in the first place? You increase the probability, which is what this means, of a default, but in reality, it's never going to happen. But could it happen?
Well, it could happen. Now, one thing, let's talk about the debt as a percent of GDP, and probably the reason why it won't happen is because, as Herb Stein, who was an economist, a colleague of mine actually, had this famous line. He said, if something isn't sustainable, it will eventually stop and turn around. and so I anticipate that there'll be adjustments that start bringing this debt as a percent of the GDP down. But maybe that's wishful thinking. Maybe the best way to do this is actually something that I'm pushing for, and that is that we have a constitutional convention and we change the Constitution in the United States to include something like a Swiss debt break, where government expenditures couldn't go up any faster than the rate of growth in real GDP, and over the short term, the fiscal accounts would have to be balanced. You could have a deficit for a year or two, but then you would have to have a surplus for a year or two and balance the thing out. That's what the Swiss, in a referendum, decided a few years back, with 86% of the Swiss voting for changing the constitution in Switzerland. So you had this debt break put in. And that's the only way to do it, really. The other solutions are kind of ad hoc. You could have a statutory change in the law, but we've had those various statutory changes in the United States in attempt to control a debt and deficit, but they temporarily work sometimes, and then they're abandoned. So you really have to change the Constitution. So that would mean Article 5 of the Constitution would have to be invoked, and you'd have to have 2/3 of the states agreeing to have a convention and then work the thing out in a convention and change the Constitution. That's the only way, I think, to really solve the problem.
Professor, you mentioned that if something is not sustainable, it'll eventually reverse. At what point, at what level of debt to GDP do you think it becomes unsustainable? Is there a number?
I think anything over about 80% in a country like the United States puts you in the not maybe in the twilight zone, but kind of in a danger zone. It's like driving your car. Let's say you're driving your car down a super highway at 60 or 70 miles an hour. Well, that's pretty safe, but what if you get it up over 100 miles an hour? That's dangerous, and that's basically what Fitch has done. Fitch has said, you can drive the car between 60, 70, 80 miles an hour on a good highway, but you get it up to 100% with the projections that you're going up to 181% in 30 years, and they're saying, hey, it's time to slow down, fellas, and until you do, we're going to downgrade you a little bit. And what does that downgrade do? Well, that downgrade, it's a black eye. It's not really good for your reputation, and it's embarrassing, and it's got all of the chattering class, the political class in Washington, they're running their mouths off today saying, it's not a big deal or anything. Well, it is a big deal because the interest cost on the debt will go up. And that cost, the taxpayers have to pay for that. So by running the car too fast, this is Bidenomics in action, you see. Everybody's talking about Bidenomics. Biden is running his mouth off, the president of the United States, about all the wonderful things that Bidenomics has generated. Well, one thing that's generated is a downgrade in our debt. How about that?
Professor, to use your cars on the highway driving fast example, yes, we're driving over 100 miles an hour, but so are all the other peers in our all our other allies are doing it. Japan, look at Japan's debt level. Look at the UK's. Everyone's driving fast on this highway.
Yeah, well, everybody's driving a lot faster than they were before COVID because there's been a lot of reckless government spending. Now, Japan is kind of an interesting case because Japan, everybody said, well, the sky is going to fall in because Japan has over, I can't remember the exact number now, but I think it's something over 200, north of 200% of GDP. And the thing is, they have been able to do this because they have a tremendously high, the government runs a deficit and the government builds up a lot of debt. But the private sector in Japan has a very high savings rate. So they've been able to domestically finance this because they have tremendously high savings. In fact, if you combine the public sector and the private sector, they actually have a surplus in savings. They're actually exporting capital in Japan. So it's kind of an unusual case. Now you say, well, why don't they have inflation? And they don't have inflation because the money supply has not grown very fast. You read the newspapers are all wrong on Japan. They say Japan has had an ultra loose monetary policy because interest rates are low. And they've had this so-called yield curve control mechanism trying to artificially keep even long-term interest rates down. Now they've just past week, loosened up on that a little bit. But the key thing is the money supply. Since November of 2021, the money supply has never grown more than 4% per year in Japan. And right now its growth rate is 2.6% per year, year over year. Now that is a long way below what Hanke's golden growth rate is in Japan. My golden growth rate, which would allow them to hit their inflation target of 2%, that's 5.1%. So they have very slow money growth, and the inflation has not been, of course, a big problem. Now they think it's a big problem. It's 3.3%, but it'll come down because the money supply is growing very slowly there. So forget this idea that they've had loose monetary policy because they've had low interest rates. As Milton Friedman told us, monetary policy isn't about interest rates. It's about the change in the money supply. You got to keep looking at the money supply.
Going back to your solutions, potential solutions to this problem, Professor, it strikes me that the government can just, in theory, continue to monetize this debt and pay it off using more money from the central bank.
Well, they can, and if you do that, you get inflation. That's what we had. You see, people say, well, if they didn't increase taxes to finance all this big increase in government spending and they created a deficit, well, how did they finance a deficit? it had to be financed some way, and they didn't do it by increasing taxes. What they did, they issued government debt, and instead of issuing that debt to the non-bank private sector, the Fed bought over 90% of it. The central bank did. So that's what we call monetizing the debt. So the Fed credits the government for the treasuries that they buy from the government. And when they do that, that increases the money supply. And that's why the money supply went up and hit a peak in 2021. It was growing about 26% year over year. The highest rate of growth in the money supply on an annual basis we've had since World War II. And now it's contracting minus 3.6%. So we've gone from this huge explosion in the money supply with a lag. We then got inflation, and now we've had this contraction going on really since early last year, and we have seen prices come down. Inflation is down at 3% now and going lower, and with a lag of 6 to 18 months after big changes in the money supply, we see real economic activity change. And that's why I can say with confidence that we will have a big slowdown. I can use the R word, a recession, and early in 2024, the first half of 2024. It's baked in the cake in the sense that the money supply has already gone way down. And with a lag of 6 to 18 months, you get changes in real economic activity. And those changes with that lag will come in the first part of next year.
Actually, Fitch agrees with you. They said in their report, tighter credit conditions, weakening business investment, and a slowdown in consumption will push the U.S. economy into a mild recession in Q4 2023 and Q1 2024. Let me ask you, Professor, if you were your own credit rating agency, or you worked at Fitch or Moody's or whatever the case may be, would you have done this today or even before today, a while ago, which is to downgrade the U.S.?
Yes, everything you've read off about what Fitch is said about the rationale for the downgrade, I agree with. Now, the mechanics of how they actually do the downgrade, I'm not out in the weeds on that. But the basis for the downgrade that they've indicated, that you've repeated, is sound. I agree with it.
There's another interesting two pieces of stats I want to bring to your attention. You're aware of this already. According to the St. Louis Fed data, the federal government expenditures on interest payments skyrocketed. You mentioned this earlier in the interview. It's exactly just under $1 trillion. It's more than almost doubled since 2022. Now, the federal government tax receipts currently stands at just under $3 trillion. It's actually declined from Q4 2022. Now, this ratio has been contracting, meaning the tax receipts are now just over 3 times current interest payments. Do you think the government, looking at the statistic, is going to say, well, we need to start catching up here. We need to broaden this ratio. Maybe it's time to raise taxes. It's easier to raise taxes than to reduce our debt or interest payments on the debt.
Government spending. In other words, they to get control over this unsustainable deficit and debt increase that we talked about, you either have to cut back on government spending or increase taxes. And the best way to do it, and all the academic literature shows, cutting back on government spending gives you more bang for your buck than increasing taxes. Increasing taxes are really what introduces the pain into the system, not cutting back government spending. government spending will actually increase the rate of growth in the economy.
Do you think this downgrade will influence Jerome Powell's decision on Fed policy going forward?
No.
So he's going to stick to his guns on fighting inflation. What do you think he's going to do next? We haven't spoken since the last rate hike decision.
Well, let's put it into context. Powell was the one who produced the inflation in the first place.
Okay.
So he's going
to put out his own fire.
He's trying to put out his own fire. I think he's not done it in the right way, and the right way would be to be paying attention to the money supply growth. And if he'd been doing that, he would have never monetized the debt in the first place, and he would have kept the rate of growth in the money supply around 6%. He would not have let it explode up to 26% on an annual basis, and he would not be in the situation where now they're contracting at 3.6%, minus 3.6%. So he's mismanaged the whole thing. And the reason for that, he has rejected over and over again. You and I have talked about this since day one. He's rejected the quantity theory of money. Now, what does that mean? What for the average person, they don't even know what the quantity theory of money is. The quantity theory of money just says money counts. Money is the fuel that runs the economy. Powell says that it is not, but it is the fuel that runs the economy. And they put way too much fuel in the tank. And now that excess fuel has been drained off just almost completely, to the point where we're really running on fumes now.
Let's assume you're right, and many economists agree with you that a recession is coming by next year.
I don't think we have to assume anything. I am right.
On recession, I mean, on your recession outlook here. I'm not talking about inflation. Yes, you've been proven correct on your inflation projection. I'm talking about next year. Let's assume a recession hits. Do you think Powell is going to cut rates into this recession once it hits?
It's a little bit hard to tell what he's going to do. Now, the reason for that is that all the Fed officials, including Powell, they keep saying, and they're doing, by the way, they're what they call data dependent. They watch the data. And of course, we don't know exactly what data they're watching. Where they have their finger in the wind that will change their policies if the data are changed. But I think one thing they look at very carefully is the labor market. What's going on in the labor market? Now, all the labor market statistics, a big problem is they're lagging indicators. They're kind of the last thing that changes. So if now we do have to make an assumption. We have to assume we know what's in Powell's head, which I don't know what's in his head. In general, I do, and that is they're data dependent. They're watching the data. They're focusing on the labor market. He still thinks the labor market's pretty hot. It's starting to weaken, by the way, around the edges, but it's if you look at the data today, it looks pretty solid today. But it's a lagging indicator. The economy starts crashing way before the labor market starts acting up on you. So they're kind of behind the curve if they're looking at these data. And then they're looking, let's talk about inflation. We've got the producer price index, we've got the consumer price index, and we've got the core consumer price index, where you have energy and volatile food prices taken out of the core. Now, what you find, if you look from 2020 until the peak in 2022, in March of 2022, I've been looking at this in some detail, David, and the results are interesting because producer prices are much more flexible than consumer prices. And then the core consumer price is the least flexible of all because you've taken the two volatile things, food and energy, out. So that's the least volatile. So what happened is that first producer prices go up, but they're not looking really at producer prices. And then the next thing to go up are consumer price indexes, but they're not really looking at that. They're looking always at core things. And the last thing to go up that lags way behind is the core. And on the way down, it's been exactly the same thing. Producer prices go down first, and then they're followed by reductions in the consumer price. And then the last thing that's been following is the core consumer price index. And what is the Fed looking at? Well, they're looking at the most lagging indicator of prices, and that's these core things. They're at the back of the bus. They're the last thing that start changing. But that's what the Fed is focused on. So that means, again, just like the labor market, they're kind of behind the curve. They're looking at current data, but I would argue they're looking at the wrong data. They're not getting ahead of the curve. They're always behind the curve. So if they do pivot as we go into recession, they'll probably, given the data that they've been looking at, they'll probably pivot late in the game.
I think Jerome Powell has indicated he'd rather be late than early. So you're probably right. Professor, may I offer another theory, and please evaluate this. So if you strip away food and home and energy, you're right. The core PCE has been sticky for the reasons you've mentioned. I've looked at the University of Michigan Consumer Sentiment Index broken up by income. The wealthy are feeling better than the lower tercile of income. And I wonder if the services component of the CPI and the PCE have been sticky upwards. I'm talking about restaurant spending, discretionary spending, so on and so forth, because the wealthy still have the money to spend despite a coming recession.
Well, yeah, right. So what happens with inflation? The inflation tax is a very regressive tax. It hits the lower income people harder than the top. In fact, the top benefit. The top have wealth accumulated, and what happens when you goose the money supply? Asset prices go up. So if you look at the billionaires in the United States over the last 5 years, so that's a little before COVID, but if you look at the data for the last 5 years, their wealth as a percent of GDP has gone from 15% to 18%. So the wealth, their relative increase in wealth has been tremendous during the inflation. It's gone from 15% of GDP owned by all wealth of all billionaires in the United States to 18%. So inflation, in short, is a good deal if you're rich and a bad deal if you're poor. And the intuition of the thing is very easy, by the way, because if you're struggling and earning your wage and you have to spend, you're spending everything. You're not saving anything. If you're forced to spend all your income, then the inflation tax hits you on 100% of your income. You're spending it all in inflated goods and services that you're buying. If you're rich, you're not spending 100% of your income. You're spending a tiny fraction of it. So the inflation tax doesn't hit you on the things you're buying, but in the meantime, the assets that you have piled up are inflating.
I'd like to talk about gold now. The Hanke Gold Sentiment Score measures the sentiment on gold at any given time. You sent me a reading, which I'll put on the screen. The latest reading is neutral. Are you surprised, Professor, that it's not more bearish, considering that inflation, the CPI that we've talked about, has been coming down?
Well, no, because remember, let's say what does this sentiment measure? Number one, it's the only sentiment measure that I'm aware of that quantifies what sentiment actually is using high frequency data every hour. So it's neutral on the hour. We're talking about an hour sentiment. It might, the next hour, it might be bullish or it might be bearish. We don't know. Or it might be neutral. It might be stuck there for a while. So we're measuring sentiment every hour, and we do this with what's called text mining. We look at the articles that come out every hour, and obviously with a computer, we're not reading every one of these things. We have keywords that are contained in those articles, and the computer finds those words. And some of those words are bearish and some are bullish. And when the computer gets done with its text mining, we can determine whether that article is bullish or bearish on gold. And that's how you get the sentiment score. And then what if the sentiment score is an extreme? Let's say it goes very bearish. You mentioned the word bearish. Let's say it goes very bearish on us, and the scores go from -10 to +10. Let's say it swings over to -10, very bearish. What does that tell me to do? That tells me that the price of gold will increase. Once the extreme bearishness is in the market, it will revert, and the bearishness will come out of the market when the sentiment, and when it comes out of the sentiment, the price of gold goes up. So yes, the track record now, it's a little over 60%. When we reach extremes, either bullish or bearish, we know with a 60% probability that not only will the sentiment reverse, but more importantly, 60% of the time or a little more, the price of gold will go in the opposite direction. So if you get an extreme bearish indicator, the price will go up 60% of the time. And if you get an extreme bullish reading, the price will go down 60% of the time. Now the key is we have algorithms we're developing to trade off the sentiment. So one thing that's interesting is we're measuring sentiment for the first time on a high frequency basis. But the interesting thing is, how do you connect that to trade? And that's where we connect the trading algorithms. And so far, we're making money. If you know the reversals occur 60% of the time, you know if you get a trading algorithm, you should be able to figure out how to make money with that. And so far they are. They're turning, depending on the algorithm, the returns are about 30 to 50% per annum.
I'm just curious how the text mining works. So suppose you've got an article that mentions the word inflation a lot. We've talked about how inflation could be a bullish word for gold. But suppose the article is saying inflation is going down. Is the computer smart enough to know that this is actually a bearish article?
Yes.
Okay. All right. So you've made it advanced enough to understand.
As amazing as it may seem, these things are smarter than you think. But the key, this is the key to artificial learning and artificial intelligence, whatever you want to call it. You have to be smart enough to program the computer, and you have to be smart enough to get the dictionary of what is a bearish word and a bullish word. So it's just not a mechanical thing where you set a computer wild on something and the computer does everything. You have to know what you're doing, and you have to give it directions. Once you give it directions, it does a lot of work for you because it reads the article. Hanke doesn't have to read the article.
But okay. All right, so you don't have to go in and manually tweak certain things if it's reading an article wrong.
No.
You trust the system. We've talked about bullish words a lot. Can you give us just one or two words that may indicate a bearish sentiment for gold?
Yes, interest rate increases.
Yeah. Yeah, that makes sense. What is your personal sentiment on gold right now, given everything that's happening?
Oh, you mean long term? Now we're not talking.
No,
Remember
we're
the
not talking hour by hour. No, yeah,
yeah,
we're not.
yeah,
Yeah,
we're not
what's your?
talking about our fundamentally. Let's move from the sentiment thing to fundamentally bullish.
Uh, that's interesting, considering that real interest rates have been rising, and that's historically negatively correlated with gold.
Yeah,
Can you
but
expand on your bullish outlook?
remember, gold usually does well going into a recession.
Right. Okay. Okay. Very good. And where can we?
And
Where can we? Sorry. Yeah. Please
yeah,
continue.
go ahead.
No, but where can we access this sentiment score?
Well, if you go to Gold Sentiment Reports, www Gold Sentiment Reports, I think I have that right. You should probably put it up on your screen if you would, David, just so people.
Yeah, yeah. I'll put the correct URL. I think you've got that right. I'll put that in the screen and in the description. People can click on it. I believe there's
Yeah,
a free and a subscription service, right?
yeah.
You want to
There's
talk
a
about that?
there's a free uh, service, but for people who are serious and want to be trading and so forth, there's a small monthly charge for getting much more frequent data and other additional information you get with it fee.
I'm going to close on this. We've talked a lot about other people's research. What research are you working on anything right now yourself? A research project? Do you have time these days to do something original?
Well, yeah, this could be a long story. I in June I just finished the book on lockdowns that you know about.
Oh, that's right. Yeah, that book came out. Yeah, yeah.
That was published in London. Now that was a heavy lift. I did that with Jonas Herby and Lars Jonig. The Institute for Economic Affairs in London, IEA. That book is free, by the way, and the conclusions are that lockdowns had a very tiny effect on mortality.
I'll put a link in the description. Yeah.
So that's one book. I just finished another book, actually about 2 weeks ago, that I've been working on for some time. Actually, it turns out the late Leland Yeager and I were working on this book. I finished it up. It's called Capital and Interest on the Economics of Waiting. Now, I'm going down to the office as soon as I jump off of here. I'm working with Kurt Schuler on a book we've been working on for a number of years, on a treatise on currency boards.
Okay. Excellent.
So those are three. Is that enough?
That'll keep all of us busy to read. All right, we'll put the links to the books that are available to access. Thank you very much, Professor.
Yeah, the Institute for Economic Affairs in London. You can put the link for that book by Herby, Jonig, and Hanke, and it's free. It's free. I mean, how many times do you get something free?
What's the catch, Professor? We're taught. Professors like yourself have taught us that there's no such thing as free. What's the catch?
If you push ahead here, because you have to read the book, and there's a cost in doing that.
Yeah. Well, there's also a benefit, which is knowledge.
I'll suggest that the benefits will exceed the cost.
I think we'd agreed. All right. Well, thank you very much, Professor. Check out the links down below. We'll speak again next time. Cheers.
Okay. Great. See you, David.
See you, and thanks for watching. Don't forget to subscribe.